Ian Williams, CEO and Chairman of Charteris. We'll speak to you now about silver. Ian.
Thank you. Well, thank you for Amanda, because she gave a very good presentation on some of the merits of gold and other precious metals, actually, over what's often referred to as fiat money, which can be printed ad nauseum by all the central banks. My talk today is going to be mainly on silver as opposed to gold. Silver has roughly double the market volatility of gold. So what we tend to say to our investors is, if you want to buy precious metals, you should buy silver instead of gold, because it will go up twice as much in a precious metals bull market, maybe even more. If you don't want to buy silver or over gold, you shouldn't buy either of them if you don't want to own precious metals. We can't really see any argument for buying gold instead of silver if you believe we're going to have a bull market in precious metals. Now, at Charteris, we tend to specialize in market cycles. Now, that's not economic cycles, these are market cycles. So the first chart we've got up is a 7.3-year cycle in the price of silver. So roughly every 90 months or so, silver hits a major low. Has done, going all the way back to 70. The charts go back a lot further. We've just chosen only to take the chart back to that date. And basically, silver hit its 7.3-year cycle low about a year ago. We don't just invest just because it says that's the date it's going to bottom, but by using this type of analysis, it's pretty unique, because you can put a date in the diary at a forward date, and then you look for other types of behavior that would tend to confirm exactly what you see at most market lows, which is capitulation selling, everyone turning bearish, all the usual things that happen in every single market, whether it's equities, currencies, or whatever. And about a year ago, this was due to hit its cycle low, and the shares were trading at virtually unbelievably depressed levels. Everything was really pointing to what's turned out to be a quite fantastic investment opportunity, which we think is only in its infancy, because a 7.3-year cycle doesn't only go up for 1 year. These are multi-year cycles. So if it's symmetrical, and they're not always symmetrical, but if they are, it should roughly go up for 3 or 4 years, which ties in with a lot of our longer range cycle stuff, which is predicting a peak in the entire precious metal complex around about 2020, 2021. This chart, as we mentioned before, highlights the volatility of silver over gold. So you can see silver is the black one, gold is the yellow one. We think, if we're right in the cycle analysis, we're only about a year, 18 months or something into this. So what we expect to see from here on is not only that will silver continue to outperform gold, but the rate of outperformance will get better. Because as the bull market, if we're right on this, if the bull market gradually develops, higher prices don't bring out sellers, they bring out buyers. More and more people will get attracted to something that's going up. And last year, and the little graph, a little table on the top, on the right-hand side, was the top 10 performing mutual funds in the UK last year. Our fund was at the very top, but of the top 10 funds, 6 or 7 were precious metal funds. So the entire sector was displaying signs that this is the incipient early stages of a major bull market. And when these go, they go up a lot. So just a little bit on what silver is used for, going back in the real world, in the industrial world. if we look at the demand side for silver, it's roughly a 1 billion ounce market. That's 1 billion ounces of supply, 1 billion ounces of demand. 1 billion ounces at $18 an ounce is $18 billion. That's not even loose change in global financial markets. It's not even one Treasury 3-year note auction. It's absolutely tiny. Warren Buffett could buy the entire world's output of silver for a year out of his loose change account. But if you look at the demand, 25%, and compare it to the demand 10 years ago, roughly the same amount, a quarter, goes in jewellery. So of the 1 billion ounces, about a quarter goes in jewellery. Compared to 10 years ago, the red portion is coin demand. When silver went down to $15 an ounce, the world seemed to go on a silver buying spree. So that's gone up. The really interesting bit, though, is the grey bit. That's industrial demand, which is the biggest demand for silver. Of that, if you go back 10 years ago or so, 7 million ounces out of 1 billion ounces went to build solar panels. You need 2/3 of an ounce of silver to build each solar panel. As the world's going on a big solar panel building spree, 10 years later, that was up to about 60 million ounces. I think next year they're looking for something like 130, 140 million ounce demand just for solar panels. Now, the silver market, unlike iron ore and copper, is not in a glut situation. It's quite tightly balanced. Now, if you look at the supply, it's even more interesting. Again, you've got about 1 billion ounces of supply coming onto the market. More silver is produced as a byproduct of lead and zinc mining than comes out of primary silver mines. Now, I don't know if you remember, but about, 18 months ago, Anglo-American announced that they were going to sack 85,000 workers out of 130,000 total workforce. This is a FTSE 100 company. It's unprecedented for a company to just sack 60% of its workers in one day. Now, they weren't back office staff. They were mines being closed down because the general base metal industry was in an oversupply situation. The mines that were most earmarked to be closed were all these old lead mines, because lead is a dinosaur commodity. No one wants lead pipes anymore. No one wants lead roofs anymore. 5 years' time, you probably have a nickel, cadmium, or lithium battery in your car. You won't have a lead, probably won't be a lead one. So by closing down all these lead mines, the unintended consequence was take a lot of zinc out the market, where the demand hasn't gone away, and a lot of silver. That's why zinc's gone to a 9-year high in the last year or two. So we're starting off here with a market that's roughly in balance. You're potentially going to add another 50 to 100 million ounces of demand just to build solar panels, never mind all the other industrial uses where the demand's increasing quite sharply as well. Simultaneously, you're taking potentially 50 to 100 million ounces off the market. Now, we can't see any way that doesn't have an upward impact on the price. And when we look at our cycle analysis, we have to find events going on in the real world that back up what the cycle analysis is saying. So it's no good just looking at the cycles and saying, yeah, this is going to bottom, it's now going to go up for 3 or 4 years. You have to then start looking around and finding events in the real world that would tend to validate that and back it up. So just really then to finish, we think precious metals tend to agree with a lot of what Amanda said about precious metals, negative real interest rates, and all the real drivers. Again, a lot of the fundamentals are very bullish for this sector. But I'm afraid we have to come back to the point that if you want to make money, you're going to make a lot more money in silver mines than you will in gold mines, and you'll make a lot more money in silver than you will in gold. Last year, gold was up 15%, silver went up 25%. That's about right for how they normally trade. The fund that I run was up 135%. The gearing element on the miners is much greater than it is if you just buy the metal. So, okay, thank you.